Hi, it's Lori Richardson with Cornerstone Home Lending. Just wanted to give you a look at the markets on July 18th. For the first time in the last couple of weeks, we saw investors show a preference for stocks over bonds. And the economic data released last week really had little impact on interest rates in general. And as a result, we saw mortgage interest rates end the week just a little bit higher. It's a pretty quiet news day today and this week. But today we will talk a little bit about what's happening with mortgage interest rates, a look at last week's economic data along with what comes out this week, and some housing data. So jumping right in, a couple things to note about mortgage rates just in general. Number one, a failed coup by Turkish military to overthrow the government may cause some turbulence in the markets, and that could create some uncertainty. We all know that the bond market loves uncertainty. We will continue to keep you posted with regard to what we see there. The second thing is that the Dow last week, as we all saw, hit record highs as investors continued to shift assets from bonds into stocks. And while it's important to note that rates did rise last week, they are still significantly lower than they were before the Brexit vote. So again, just kind of keep that in mind so that you can balance it in your head. Also notable is that the increase in rates has occurred despite the fact that the forecast for the Fed funds rate hike in terms of investors' eyes really hasn't changed. Investors are now assuming that we've got less, or predicting that there is less than a 50% chance that the Fed will hike rates in all of 2016. So again, less than a 50% chance that we will see a rate hike at all. And if and when we do see that, increase, it will happen at a gradual pace. Let's take a look at the economic data. We saw retail sales post their fourth month in a row of solid gains on Friday, partly due to the pickup in consumer spending, but we also saw that GDP is expected to double its 1.1% level that we saw during the first quarter. Taking a look at the Consumer Price Index, which measures inflation on a consumer level, was up 0.2% in June and 1.1% year over year. Now, the core reading, which excludes food and energy, was also up 0.2% as expected. But here's the kind of the kicker. Year over year, the core rate was up 2.3%, which was the highest level in almost 8 years. So again, good news on the Consumer Price Index front. Now, keep in mind that the CPI is above the Fed's target rate. They're looking for a target rate of inflation at 2%, but it's the PCE, or the Personal Consumption Expenditure Index, that is the Fed's preferred measure of inflation. So again, just something to kind of keep an eye on. We also saw initial jobless claims last week. Last week's report was unchanged from the previous week and holding strong, showing 254,000 jobless claims. This is better than expectations and really shows that employers are holding tight to good employees, which is great news. As a quick look at the housing data, last week we saw the National Association of Home Builders Housing Market Index released, which measures builder confidence. It dropped in July to 59. Which was a bit lower than expected, but just keep in mind that a number above 50 still signals expansion just in general. So this week we've got housing starts coming out on Tuesday, mortgage applications coming out on Wednesday, and then Friday we will see the PMI, or the Purchasing Managers Index. So again, kind of a light week as it relates to data in general. Take a quick look at rates. Conventional conforming, we are in the mid 3% range, which is incredible. The conforming 15-year fixed today fell below 3%. We're at 2.95% for a conventional 15-year fixed rate loan at par. FHA's in the low 3s and jumbos in the low 4s. So rates are still great. If there's anything we can do for you, please call. Make it a great day.